I see liquidity on the internet is a very popular topic, and a lot of people get it wrong actually. They base their whole trading on liquidity and forget the fundamentals. Now, liquidity should be used as a tool, not the basis of your trading. So in this video, I want to talk about specifically liquidity zones, which we see on the chart form, and many people are scared to take trades because they think it's either going to reject the zone or they don't understand them well enough. Again, as I said, it should be used as a tool, not as the basis of your trading. So in this video, we're going to cover how to use them and what they are exactly. So see you there. Welcome back, guys. Harry here, known as Trade Sharp. So this video is going to be a good one because we're going to look at liquidity zones in depth, and it's going to be more advanced because this is more once you understand the fundamentals. But this is also for people who trade these smart money concepts and think that liquidity is everything. No, chart does have liquidity. That's how price moves. Now we need to understand what these zones are and what they represent, but it should not be the confirmation for our trading, in my opinion, and based on the way I trade. And I want to just clarify that up to some people and to whoever may benefit of this. So that being said, we're going to get straight into the video now. And as always, guys, can you leave a like and a comment? I really appreciate it if you would like this video. It really helps get out to more people so they can benefit off this content, which I do appreciate. If we could get this video past 100 likes, I'd really do appreciate it. And if you have any questions, feel free to leave them down in the comments. And if you want to speak to me more about this topic or have questions about your charts, feel free to join the groups down below, links in the description. You can send your charts and ask any questions you have. Now, with that being said, let's start looking at what is exactly a liquidity zone. So without going very complicated, essentially a liquidity zone can be defined in layman terms, which means basic terms, as a zone where there's a pressure in a certain type of direction in terms of orders being collected. So I've marked out these two simple zones we've had that price here on GJ has been in, and these can be identified as liquidity zone. We see this is a very high sell side liquidity zone. This is a very high buy side liquidity zone, which means to say that every time price comes up here, there seems to be a lot of selling pressure, which tends to push price down. And when we have this area here at the bottom, every time that price seems to dip into this area, we normally get a sharp rejection, eventually finding our way towards the top of the zone. Now, what do we notice here? Well, we notice there are, especially on the downside move here, there are some moves that actually push through. Now, why do they push through? Because we have what, as I always say, we have candles closing below the zone. So this is what leads me into my first point about liquidity zones, which is people use it to take trades. They think, okay, if we have a range here on a chart like this, let's say we're ranging here, that this is a wick here, this is another wick, and then they think that price, and we're on an uptrend, okay? So this is price is coming from an uptrend. They think if price comes, takes this, and then they see a rejection from this zone here, if they think that it's entering into this liquidity zone, price is going to reverse. Liquidity zones are not reversals on lower time frames. And this is where people get it wrong. On lower time frames, they're looking for this and they think, okay, that's it, price is going to dump. No, we're on an uptrend. Why are you trying to counter trend based on one confirmation? You don't even have candles closing bearish. You don't have any confirmation. The only confirmation is that you saw that price, failed, tapped into this liquidity zone, and now has continued down. That's not true. That's not how it works. And then what ends up happening is that it creates high support, which was a simple retest to this zone here, and moves up to the upside. If this is considered a liquidity zone, this can also be buy side. So people can take orders from these areas here to move price towards the upside. So this is what people fail to understand. When you're trading in the trend, you shouldn't be worrying about these zones on the lower time frame. And there's a very good example that happened actually yesterday, which is why I'm making the video today, which is this. Look, so if we go here onto the 30-minute chart here and we go to London session yesterday, and this is a key example that I was seeing. So yesterday London session was around here, and we'll go on a 15-minute so we can see what was happening. So this is what's happening yesterday. So obviously people were, it was a mixed session. You could argue both sells and buys, but honestly, coming from this pivot here, we were still holding higher support above this zone. So yes, we were coming down here, but what was very important here is we made this transition here. So market structure changed. We came down. If we wanted to break down, we should have broke down here. Nope, we changed structure, holding higher support. But everyone was seeing this zone right here, and they were like, all right, that's it, this is a liquidity zone. And why we call it liquidity zone? Because we can see every time price came into this zone, we reject, came into the zone, we reject, we tried coming here, we reject, we reject. So that's why we can identify that there's a lot of sell side liquidity in that zone. But that doesn't mean that they can, that, you know, these big institutions and whoever can use that sell side liquidity to take buys. You know, liquidity just means what they have on the books to place orders, right? So you need a liquid book to be able to place orders. These big guys, when they put in big orders, they need, because markets work off a 1-to-1, which I always say, for every buy there's a sell, for every sell there's a buy. So they need these orders, you know, they need the liquidity to place these orders. You know, it's not like us trading with, you know, 5, 10, 15 lots, whatever, 20 lots. You know, and even some people trading 50 lots, that's still not relevant on the big for the big boys. So that's very key to understand. So we saw this liquidity zone here. Now I was saying, for me personally, I want to see closures above this area, and I said for sells, and you can see this in my group where I put the analysis. For sells, I'm not very interested until we create some structure below here, because if we created structure below here, I know we have an easy shot into this zone. But after seeing this rejection, we need to get back down here. And I wanted a 4-hour bearish close. So I was seeing this zone, and people were thinking this is a liquidity zone, and this is a potential to get something like this. We head up here and then reverse. And I was like, no, that's not necessarily how it's going to work, because if we're rejecting these lows, creating higher low, that's a high. And if we're going to continue this uptrend that we've created pre-session here, we need to hold these higher lows, and then when we get the breakout, we can target our next relevant area, which was here. That was the target, and it was a very simple trade here. But everyone was looking at this liquidity zone and being like, oh, you're gonna get rejection from here. You got the absolute opposite. You got a very nice clean move towards the upside, and this is where it will confuse people. So now, where do we use liquidity zones, right? So how are we gonna use a liquidity zone? Liquidity zones are very powerful on higher time frames. When it comes to higher time frames, this is when you should be looking at liquidity zones. For example, you should be looking at this area here is a clear liquidity zone. Why is this zone very important on higher time frames? Because we can use it as targets. On higher time frame, liquidity zones should be used as targets. This is a target now, and this is a target. So selling here, not a good idea. Selling here, not a good idea. Selling here, not a good idea. Why? Because we have entered this zone, right? So selling in these zones will be a bad idea, because this is an area of rejection or liquidity. You can call it rejection as well. It's a rejection zone. So using these as targets is always a good idea on higher time frames, and even in your intraday session. Yesterday's target should have been to this resistance here or in this zone. Where did price come up yesterday? Into this small rejection zone we've been having. So you have to understand, on lower time frames there'll be different liquidity zones, but you can see here that we've had this small zone. Where does price come to? Within this zone. So using them as targets is the smartest way to use them, not to put you off trades. And this is what I was saying in the beginning of the video. It needs to be used as a tool, not as the basis. You can't forget about market structure, candles closing bullish, session bias. You can't forget about all of that and just say, oh, I see some wicks, it looks like it's a liquidity zone, I'm not going to take the trade. Or if it enters that zone, I'm going to press sell. No, that does not make sense. You can't do that, because you can't forget about everything. But liquidity zones can become very useful to have targets, because I guarantee you there's a lot of people who would have sold on this daily bearish close, who would have sold on this daily bearish close, who would have been selling in this zone. But we know all the way coming back from this zone here that this area here has been trouble. So this is where we use liquidity zones to act as targets for our session, so we're not on the wrong side of the trade, right? And then you get people say, oh, this is manipulation, look at this wick, this is no, it's not manipulation. We know this zone has been rejection for a long time. I mean, how many times would have you guys, if I just rewind the chart like this and I draw two simple lines here, look how good this looks, right? I draw one line like this, here's your support, here's your next. How good does this candle look to drive into this zone here, into here? How good does that look to happen? But people forget that this is a huge rejection zone. And if we play and look next candle, oops, rejection. Why? Because we know our zones. So now where does price go? Actually, this is great. So now that So let's say we see the rejection come in, boom, rejection in. Okay, where's our next target? Well, we can see this resistance up here and this whole zone essentially, which is another liquidity zone, and where we can target. So if we're taking buys in this lower time frame here, we can be looking to target into this next liquidity zone up here. And guess where price rejects? Let's see. Oh, into that zone. Then what happens? Oh, rejection. Very big surprise. No, this is how we can use it as a tool to have targets in our session, right? It's very, very simple when you put it like that. I don't understand why the internet makes it so complicated, makes it seem like it's a huge thing. You need to take out buy side liquidity, take out sell side liquidity. No, look at candle closures. That candle closing back in the range gives you a clean shot. Let's go on lower time frame and look at all the trades opportunities you had. Boom. Look at this change of structure, closing back into your daily range. That's the daily line I drew. Any buys in here make sense. First target here, we get reaction there. Second target, top of your range. Very simple. And what were we, and this is what people don't. Yesterday we were taking buys in here. Why were we taking buys in here? Because it started from this whole move. That's why buys essentially made sense. But in a session, you have to understand sessions are different, because on the higher time frame, in a session you can have sells, but that's just a pullback on higher time frame. So that's where the confluence is, and sometimes where people get confused. But that's what I want to explain about liquidity zones. Same thing here. You can find them all over the charts, and this is where people get it wrong. Strong reaction should not be looking for sells. People are going to be like, oh, look at this, we have a huge liquidity zone. Every time we've tapped into the zone, rejection. Here's a rejection, yeah, but this was just a pullback to continue the trend up. So use it as a target, not saying I'm going to sell and try catch a reversal. So I'm going to end this video with a very, very, very simple thing. Liquidity zones are mainly targets. They are not going to necessarily always be reversals, and you have to understand that very clearly. Now, in terms of this zone here we've had on the higher time frame, which has been very strong, yes, every time we come into it, it's been a reversal. But that doesn't mean the next time we can't push through. You have to have the confirmation. Pullbacks, breaking structure below here give you the chance to come down. You understand? This knowing that, see, if you didn't know this about this zone, you'd be try taking buys on this candle here. Let me remove all these drawings. If you didn't know about this zone, I'm sure you tried to buy this, tried to buy this candle, tried to buy this. You'll be trying to buy all of these candles. But since you know about these zones, you can be, okay, it's not smart to take buys. It's also not smart to take sells, because this could be the candle that pushes through. Right? So what happens? You wait for confirmation, change of structure towards the downside, and take your trades if you want to try catch a reversal. That's it. So that's how I'm going to end this video. Hope this video helped you guys. Let me know in the comments if you enjoyed it. And as always, guys, take care, trade sharp, and until next time, peace.